I'm Thomas Moore, manager of the Aberdeen Equity Income Trust. We've constructed the portfolio across 3 different categories, which we believe will enable us to achieve our investment objective. So if we run through these 3 categories, first of all, dividend growth. We see certain companies and sectors as offering particularly strong visibility on dividend growth in the years ahead, thanks to the strength and resilience of their corporate fundamentals. So this category represents around about 1/3 of our portfolio. And we see such names as BP, Shell, and HSBC as examples of companies where we see years of good, solid dividend growth ahead. Secondly, we have a category which we call mispriced yield. And this is again about 1/3 of the portfolio. And these are stocks whose share prices we believe do not reflect the strength of the underlying cash flows and dividends these companies are paying. And one such example is a North American oil and gas producer called Diversified Energy. This company produces much more resilient cash flow than the market is pricing in, partly thanks to their policy of hedging production, which gives them great visibility over cash flows quite a long way out. The third category is what we call unrecognised change. And these are companies where we see a robust market position, but in the short term, the market can overlook that robust market position. The market can be destabilised by macro volatility, when in fact, what we see in many cases is companies whose prospects are very strong. And during times of macro volatility, we often find that these companies can trade at really attractive valuations. And it's the valuation re-rating that we see as the key driver of capital growth from these companies as those valuations move higher. Now, what is the current market conditions that we are seeing and how are we expecting those to change? Well, firstly, the market conditions at the moment are dominated by mega cap stocks, particularly US tech stocks, but we're seeing this around individual markets around the world. We're seeing that a lot of assets have flocked to a small number of stocks in each market. And that's a function of the uncertainty that people are feeling over the macroeconomic and political outlook. In many ways, this is all linked to rising interest rates. And we believe that as soon as there is any inkling of interest rates peaking, we could well see a lot of the assets that flow to these small number of mega cap stocks coming back the other way and looking at these materially mispriced stocks across the small cap and mid cap parts of each stock market. And we believe the UK is particularly well positioned to benefit from that, given how many years of macro uncertainty we have seen here in the UK. In the meantime, what we have is a stock market that generates a huge number of high yield stocks. We believe that at the moment, that's the key opportunity. Among high yield stocks, we're finding lots of those which are paying covered dividends and yet are yielding in excess of the UK base rate. And we believe that many of these companies have just been overlooked in this mad dash for these mega cap stocks. So we believe it's a good time to be looking at dividends. High yield is a factor that hasn't worked in recent months and even in recent years, but we believe that dividend yields time is coming as a style factor. And we're excited about the recognition that some of these companies we're investing in are really well positioned and have great prospects in the years ahead. And that will provide the kicker. And while we wait, we're getting this very attractive dividend income. In looking to achieve our investment objective, we seek to identify UK stocks whose potential has not been fully reflected in their valuations. And we do that right across the market cap spectrum, all the way from small caps to large caps. We believe that gives us the best possible breadth of opportunities. So if we start down at the smaller cap end of the market, we took part in an IPO back in December 2020 in a company called Conduit. And this is a reinsurance company based in Bermuda that was starting from scratch at a particularly good time, given the increase in insurance claims causing an upward movement in insurance premiums globally. This was a time when many other companies had come a cropper, and so there was a lot of capacity exiting the reinsurance market. Companies which had some sort of legacy problems. And of course, Conduit, as a new entrant to the market, had no such legacy problems. They had a clean balance sheet to start investing with a really respected management team. And this management team has now put that money to work and is starting to generate some really attractive returns. And we're seeing that now coming through both in the form of really good solid dividends, stock yields about 6%, but also good growth now in the share price. Now, all the way over the other end of the market cap spectrum, we've been adding recently to HSBC over the last 6 to 9 months. And what we see in HSBC is good, strong momentum in their revenues. Now, banks clearly generate a lot of their profits from net interest income. That's to say, the difference between what they pay to depositors and what they earn in interest on loans. And a company like HSBC is particularly well positioned because they've got so much in the way of deposits. They're well known across the sector for being one of the most conservative management teams in terms of the gap between their loans and their deposits. And that ratio looks particularly attractive at the current time, with interest rates having increased so much. At the same time, activity in Asia is starting to free up now after years of COVID lockdowns. And that will begin to improve the outlook for a company like HSBC, which does so much of its business across borders. So by looking for these opportunities, all the way from the smallest cap stocks to the largest cap stocks in the market, we're able to identify opportunities that will help us to deliver both income and capital over time. We do recognise that the cost of living is rising, and as a result, investors are looking for ways in which they can generate an attractive level of income. We believe that Aberdeen Equity Income Trust can help by offering a differentiated and diversified portfolio. For more information, please go to the website or click the link in the description. Thank you.